Imagine a car barreling down a highway at 100 miles an hour, heading straight for a cliff. Now, imagine the driver isn't looking at the road, they're staring at their phone. Right now, that is exactly how the stock market is behaving. Tensions are boiling over, conflicts are expanding across multiple borders, and critical global shipping lanes are shutting down. Yet, if you look at Wall Street, you'd think we were in an era of perfect peace. The indices keep hitting all-time highs, flashing bright green across the trading floor. So what's really going on here? Are everyday investors delusional to keep buying in this environment? Or does the market know something you don't? By the end of this video, I'll walk you through the 3 deceptive traps institutions are actively setting for retail investors right now, and the one specific asset class the ultra-wealthy are quietly using to shield their capital. Because staring at this massive disconnect creates a vicious psychological loop. You check your 401k, see the gains, and feel the greed to keep pushing. But deep down, there's a gnawing anxiety that the rug is about to be pulled. In psychology, there is a term for this: normalcy bias. It is the hardwired human tendency to assume that because total disaster hasn't struck your life yet, it never will. Wall Street is currently feeding that bias. It is floating on a massive wave of liquidity, banking on a few giant tech earnings to act as a smokescreen over the global reality. Operating under normalcy bias leaves your portfolio completely exposed. Geopolitical risk is a slow-burning fuse. It doesn't matter how bright or steady the flame looks while it travels, when it finally reaches the dynamite, the explosion is instantaneous. Most beginners operate under a very simple assumption. Bad news hits and the market crashes. Good news hits, the market rallies. But the market isn't a person reacting to fear. The market is a forward-looking calculator. When a crisis hits, there's a dip, but it immediately prices in future growth, trending upward. While the media drives retail panic selling, professionals have already priced in the recovery, accumulating assets along that steady trend line. What professionals actually watch for are supply choke points. A conflict miles away only matters to the market if it suddenly disrupts global energy flows and sends gas prices and inflation soaring back out of control. Unless a specific conflict directly damages economic growth or central bank liquidity, the mathematical reality is that the market will simply ignore the emotional noise. But millions of everyday investors confuse that uncertainty with guaranteed disaster, and that fear pushes them directly into 3 massive wealth traps. The first is the passive index illusion. For years, the safest advice was to buy an S&P 500 index fund and forget about it. Today, a tiny handful of mega-cap tech stocks are carrying the entire weight of that global market. If a geopolitical shock disrupts the supply chain for these specific microchips for even 1 week, the giant pillars holding up that passive index will crumble. You aren't globally diversified, you are highly concentrated. The second trap is FOMO momentum. When retail investors see the market shrugging off bad news week after week, they get brave. They start aggressively buying right at the absolute top of the rally. Meanwhile, the smart money uses that exact surge of high-liquidity retail buying to quietly exit their positions. They sell into the rally, happily passing the bag to beginners before the music stops. So you might think the move is to pull everything out and sit in cash. That is the third trap. In an unstable world, sitting entirely in fiat currency guarantees you lose 5 to 7% of your purchasing power every year to inflation. Whether you're passively indexing, chasing after momentum, or hiding in cash, you aren't actually avoiding risk. You are walking directly into wealth destruction. The professionals don't panic sell, they pivot. They use a method called the barbell strategy, carefully balancing extreme protection on one side and hyper-growth on the other. On the growth side, they look for asymmetric bets. These are sectors like defense manufacturing, cybersecurity, and global energy infrastructure. Their demand skyrockets exactly when global tensions rise, meaning the upside is massive during a shock. On the protection side, you must hold true safe havens. I'm not talking about speculative tech, but assets that act as concrete shields when paper markets panic. We are talking about physical gold, short-term U.S. treasuries, and critical natural resources. When the world feels unstable, hard assets rule. The goal of this strategy isn't to beat the S&P 500 by 500%. The goal is to ensure your capital remains safe and liquid, so when the rest of the world is frozen in panic, you are ready to buy generational assets at a massive discount. Adopting a resilient mindset means globally diversifying your wealth and keeping dry powder ready. You do not need to successfully predict the exact dates of wars or ceasefires to protect your money. The markets aren't completely ignoring geopolitics. They are looking past the immediate destruction, pricing in future innovation and human resilience. I want to hear from you. Drop your biggest specific geopolitical concern in the comments below. What is the one risk you think the market is severely underestimating right now? The stock market will always climb a wall of worry, but true wealth is preserved by those who ignore the emotional noise, stay disciplined, and build better walls. See you in the next one.